Okay guys, as I was making a research on how to succeed more in trading and in crypto, I found something very amazing, something you wouldn't like to miss. As you are going on to this journey to succeed in crypto or in trading, just like I am, these tools are going to help you. And these are 5 high-level tools that the institutional traders are using to stay ahead of the game. They see things before the retail traders see it. So whenever a retail trader is jumping into the market, maybe he's seeing a bullish engulfing candle and jumping into the market, something happened behind the scene. And the institutional traders have tools that help them to predict all these things. Some of the tools I'll be mentioning today, you've not heard about them before. This will be the first time you are hearing of it. So make sure to watch this video to the very end, especially the 5th tool. You wouldn't like to miss this because you'll not see it anywhere else. I've made my researches and people are not talking about it because everybody is hiding it kind of. And I'm here to reveal it to you guys because I know the same way I want to succeed, you guys want to succeed as well. So guys, sit back and enjoy the video and make sure to hit that subscribe button. Now guys, let's go. In 2021, a friend of mine was overly obsessed with crypto, just like we are. He bought every course, followed every single Twitter gurus, yet he kept buying late and selling early. Just like many of us, watching YouTube videos, checking price predictions, hoping that price will keep going up. Yes, it's still going up. But what he didn't realize was that while he was watching influencers screaming, "We are going to the moon," institutions were quietly unloading their bags. They were not listening to hype. They were listening to data. That loss was a turning point for him. So I went deep, started studying institutional grade level tools, on-chain metrics, fund flow trackers, and a whole lot of them. And that's what I'm sharing with you guys today. The tools the institutions actually use to get in early and exit before the crowd. Now let's dive in. The number 1 tool is the MVRV-Z score, the Waves temperature check. It compares the current price of an asset to the average price of which all coins were bought. So what exactly is the MVRV and why do institutions care so much about this tool? Let me break it down for you. MVRV simply stands for market value to realized value, and this is what it means in simple English. Market price is just the current price of all coins in circulation, basically what the market thinks the asset is worth at the moment. While realized value looks at the actual cost basis of those coins, the average price at which people actually bought them. Think of it like this. Imagine you are in a neighborhood where people bought most of their houses at the price of $200,000. Then a bidding war came and took those prices up to $600,000. Now, the market value of those houses is the sky high price, which is the $600,000, while the realized value is the actual amount that most people got their house on, which is what, $200,000. Now, the interesting part is when you divide the market value by the realized value, it gives you a number that tells you how far we have gone from reality. And that is exactly what the MVRV does in crypto. So if Bitcoin's MVRV score is above 7 or the red zone, it simply means that the price is what in overbought region, which means that it is higher than what most people paid to get a piece of Bitcoin. And it often signals that the market is overheated, overvalued, and institutions and smart money start taking profit. While some retail traders that doesn't know about this tool will be getting in, hoping that it will reach to the top, it will break the moon and go to Mars or whatever, go hit the sun. If it's between 0 to 6, it means that the price is fair or in a building or accumulation phase, and it's very good for swing traders and also for low DCA into the market. So you can keep buying up since we are still at the middle. Now, if the MVRV gets to 1 or below 1, it means that most prices are actually underwater, which means that it is trading below the price most people paid for. Just like in the past cycle, the MVRV score dipped below 1 around the 2015 bear market bottom, the March 2020 COVID crash, and the 2022 post-FTX collapse. And each time these things happen, the smart money slowly and quietly keeps buying while the retail traders panics and sell. They are selling at the bottom while the smart money are buying. And it's simply because they are using this to know when we are at the bottom. So it's like walking into a luxury store and you now found out that all the goods there are on 70% discount. and it's only the insider that knows where the sale track is. Now, that MVRV is that sale track, and some retailers don't know about it. But today, you're lucky that you know about them. You'll be using it for your charts, and you'll be making your decision just like the institutional traders. One more thing you need to know about the MVRV is that it doesn't tell you to buy or to sell any assets, just like influencers do. No, it simply tells you, hey, Bitcoin is trading below the price everybody bought it at. This is rare. Pay attention. Now it's up to you to take action, to take the risk and get in. And many institutional traders don't base their decisions on emotions. They base them on data. And MVRV gives them that data. Once they see it, they get in without second guessing. But they don't just use the MVRV. They look at it with other tools like on-chain flow, exchange balance, and stable call ratios, and a whole lot of them out there. I'll still talk about some going forward with this video. So they use all these tools to figure out when the market is irrational, either overly greedy or extremely fearful. Most retail traders never check the MVRV. They chase the green candle and FOMO into resistance. Meanwhile, the pros are using the MVRV to outfront the crowd. So next time you are thinking of buying or selling Bitcoin or any altcoin, ask yourself, am I making my decision based on data? Am I making it based on emotions? What data do I have to back this? Am I trading based on noise or on value? Pull up the MVRVZ score and check where the market is currently at. And you can track these on sites like Glassnode, or you can just search for MVRV on Google and you'll see the charts. It's color-coded, and when it hits red, smart money starts taking profit. When it hits green, you start getting it. You can also add that to some of the tools you have to help you to make the best decisions, just like the institutions do. So comment below if you have ever bought on a red MVRV zone without even realizing it. You all have done that. I've done that as well. So I know possibly you must have done that. So share your comments on that. Let's see. Now let's move on to the next tool, which is the CoinDays Destroy, or CDD. This is when the sleeping giant moves, also referred to as dormancy metric. I know you've not heard of it. Some of you may have heard of it, but let's go into the dormancy metric, the CDD, how it's being used, and what it does for institutional traders, and what it can also do for you and I in this crypto journey. Now, I know the name sounds a bit technical, but once you get it, it feels like unlocking a secret weapon. And here is how it works. Every single Bitcoin that exists is sitting on a wallet somewhere. And every day that it sits without being moved, it accumulates what is called a coin day. So simply, one Bitcoin held for 1 day is equal to 1 coin day. And one Bitcoin held for 7 days, that's a week, is equal to 7 coin days. And also, if you hold a coin for 365 days, that's a year, it's equal to 365 coin days. Now imagine this, someone bought 50 Bitcoin back in 2015 when it was dead cheap. And that person has been holding it up since then. That is years of coin days stacking up silently. But then suddenly, out of nowhere, the coin moves. Together, that person decides to move that 50 Bitcoin into an exchange. Now, that single transaction destroyed thousands of coin days. Now, why does it matter? Coin days doesn't tell you how many coins are moved. It tells you the significance of the movement of that coin. You can imagine 50 Bitcoin that has been there for thousands of coin days, and all of a sudden, it moves. Something must have made that person to move that coin. Someone that has been holding for a very long time. So it's either he's moving the coin to sell, or he's moving the coin to move into another strategy. So institutional traders pay very, very attention to this, because you can't just hold the coin for 10 years and just decide to move it today, just for trading. No, it's not for trading. You are moving it because you know something that others don't know. That's what the institutional traders assume, that a person with this big amount of thousands of days can't just move their coins. And it's illegit. When you see not just one person, but several persons, 2, 3, 4, 10 persons destroying thousands of coin days in a particular day or in a particular week, then it means that something is about to hit the market. It's either the market is going to skyrocket, or they are moving it to their exchanges to sell it off. And if you're not paying attention to this, if you're not using these tools, you'll still be buying while they are taking out their profit. So CDD serves as an early warning sign. It's like a seismic activity before an earthquake. In late 2021, just before Bitcoin hit its final peak, Coinday Destroy started to spike. Whales who have been inactive for years started moving their coins to exchanges to sell off. The market was euphoric, Twitter was shouting 100k next, but the smart money was already positioning to exit the market. They saw the spike in CDD and they know that the OGs are leaving the market, they are leaving the party, and they also started packing up. While the retailers, including me, we are all getting into the market, thinking that it will still hit 100k. That was in 2021, but it did not, because the OGs, the real traders, the whales, the institutions have all seen the CDD. They have used the CDD to know that, oh, big people are pulling out their money. So they pulled out their money as well. And they're also not small players, leaving the small players in the market to hold the bag. So that's why that your bag is not growing. Year in, year out, you hold it. After the bull run, you still see it go down without taking any profit because you're not paying attention to all these tools. But after today, that's if you use the information you're getting here, you put it to work, you will stop making those mistakes. Because me, I will not be making those mistakes again. That's the reason why I had to research all these things and also putting it out here so that you also learn and stop making that. Because I want you to succeed. Yes, I want you to drive that Lambo. I also want to drive it too. So what makes the CDD most powerful is not just the movement of the coins. It is about the age of the money. How long has that coin stayed idle and why is it moving now? Fresh coins move every now and then, that's trading, but old coins, they don't move easily. They move for a reason. So if you ever see a surge in the Coinday Destroy, and especially on days with no big news, take that as a quiet whisper from the shadows of crypto. Now you can find this on Glassnode, or you can also Google it and see it there. Also some sites that you have to pay and all that. So let's move on to the third tool. As you can see, each one is getting more interesting. So over to the third tool. But before that, let me ask you something that most people have never thought of in the crypto space. How do you know when there is fuel building up behind the crypto market? Or how do you detect buying pressure before price explodes? How do you do that? The answer lies in a metric that the institutions track religiously, and that is no other tool but stablecoin supply ratio, the SSR. All these abbreviation, SRP, this and that and that. I like that in crypto. Okay, now let's go into business. The SSR compares the market price of major cryptocurrencies like Bitcoin, Ethereum to the supply of stablecoins like USDT, USDC, and DAI on exchanges. What this simply means is that the stablecoin represents the buying power. That's the dry powder out there waiting to be deployed into the crypto market. While BTC and Ethereum and other altcoins represent the assets, their price moves based on supply and demand. So when SSR is high, it means that the crypto asset like BTC and Ethereum is expensive relative to the amount of cash waiting to buy them. So it means that not much dry powder is left out there. But when the SSR is low, it means that there's a lot of cash waiting on the sideline compared to the size of the market. And that is where the magic happens. Now, why does it matter to institutions? Think of the crypto market like a battlefield. The institutions, they don't attack when everybody is charging blindly. They wait, they observe. And when they see an army of stable coins piling up on exchanges waiting for the right moment to strike, that is when they strike first. You see how they play the game? So a low SSR tells them there's a ton of cash sitting idle there waiting to buy crypto. So everybody is out of the crypto market. And once the institutions see that everybody is out, they go in first. So that when you guys are coming back in, you'll be coming back on top of their money, thereby duplicating their own money. So you get the game. And when the buying pressure is paired with positive technicals or positive macro news or on-chain accumulation by whales, it adds more fuel to the fire that hasn't even been lit yet. It's like a tsunami warning system. Imagine you are standing on a beach and suddenly the wave moves out violently. People will be staring at the sea, confused, but the institutions, they know exactly what is about to happen. That violent drawback is not a peaceful retreat. They know that the water had to draw back for a massive whale that is coming offshore. And that is exactly what a fallen SSR does in crypto. It looks quiet on the surface, but under the hood, demand is coiling. The market is holding up for a potential supply shock. And the institutions, they don't wait for the pump, they position ahead of it. They know how to place themselves in the battlefield. Just like in March 2020 crash, the COVID panic. Right after that crash, the SSR dropped like a rock. Why? Because everyone fled to stablecoins. Everybody removed their money from crypto, and crypto fell massively. Everybody was just waiting. Is this market dying or what? But the institutions, they were looking at the SSR. They know that, okay, people are going out, so that means price is going down cheaper. And it means that they are getting it very, very cheap. And that was the biggest bull run we've ever had, from 5,000 to 69K. Man. Most traders like you and I only trade with price. If Bitcoin is green, they buy. If it's red, they panic and sell. But the smart money, they learn positioning. They ask themselves, where is the capital? How much dry powder is ready to deploy? Are the whales accumulating? And finally, is SSR signaling an incoming surge? The SSR gives them early access to sentiments, not the emotional hypes on Twitter, but the real capital flows behind the scene. So next time you're wondering whether Bitcoin is about to move, don't just stare at the chart. Look beneath the surface. Bring up your SSR. If the tide is pulling back, a surge is likely to come. Because remember, the tsunami never announces itself with a scream. It starts with a whisper. And those who are listening, those who have big ears like mine, are the ones who succeed and thrive. So next time when you buy Bitcoin or any altcoin, make sure to look into these tools to help you in making a good decision, just like the institutions. So the fourth tool that we're going to talk about is the Nansen, the wallet tracking tool at God level. Nansen is like the smart money radar for crypto. Think of it like the night vision goggles for blockchain. Because the thing is, every single transaction in the blockchain is public, but it's like trying to read thousands of lines of code in real time. And that's a mix of wallet addresses, numbers, and cryptic data. Most people see chaos, but Nansen brings order to the chaos by labeling the wallets and also identifying whether a wallet belongs to a whale, an exchange, a VC, or even an insider. And what does that mean for you and I? Imagine walking into the poker game blindfolded. You don't have any idea of who is the pros and who is just guessing. That's how crypto traders operate in the crypto market, blind. But with Nansen, you remove the blindfold, you see clearly. And what do you see? You see which wallets are consistently buying and selling high, which coins top VCs are quietly accumulating, and when smart monies exit a token long before the retail traders do. So let's say you log into the Nansen and you discover 3 wallets that are labeled smart money. And this smart money wallet just bought millions of a small cap altcoin that you've never heard before. Let's coin it token XYZ. You don't ape in like a degenerated gambler. Rather, you ask yourself, why are they buying now? Is there upcoming news? What do the fundamentals look like? And finally, is there accumulation happening on multiple wallets? Now, when you do this, you are not chasing the hype. Rather, you are trading with context, the same context that whales and institutions use. But let me be blunt, Nansen is not cheap. It will cost you hundreds of thousands of dollars, and that is why the institutions love it, because it's not a tool that everybody can get their hands on. It is very, very expensive. But there's a way around it, and that is what I am here to do. So you don't need to pay thousands of dollars to start learning from Nansen, because some of the data in Nansen leaks on Twitter, that is on X, on some handles. They also share some of the things that happens on Nansen. They also bring it out on X for people that doesn't have the money to purchase Nansen to also see and also make their trading decision based on that. And one of those handles is Nansen AI's own feed. So you can follow them to get feedbacks and also to see what is happening on Nansen. And also don't forget to follow us so that you get more updates. So how do you use this information? Number one is watch for repeated buyers by multiple smart wallets. One buy can be a lock, but multiple buys coordinations. So once you see multiple smart wallets buying a particular token, that is a very big sign that you shouldn't ignore. Make a research on that coin, the fundamentals and everything before opening to any token out there. So let's continue. Number 2, look for accumulation pattern over days or weeks. A one buy can just be a lock, but if multiple wallets are buying it, then it's a pattern. Something is happening there, and you should pay attention. Now, number 3, cross-check on-chain data with news, team updates, and ecosystem development. Then finally, set alerts from large token transfer from labeled wallets so that you know when they are moving their money, so that you also will move out your money or move in. So with this, you are not chasing the pump. Rather, you are seeing who started the pump. That is why they call it the God's eye. So get this tool and get other tools. And now let's move into the 5th one, the last but not the least, the most powerful tool of them all, the Crypto Quant, the Insider's Dashboard. Now this tool is, I don't know what to call it, but if Glassnode is a microscope that zooms in small details in the crypto space, then CryptoQuant is the command center, the place the institutions go to see all the panoramic view of the entire crypto battlefield. With CryptoQuant, whales and institutions monitor the heartbeat of crypto ecosystem, including exchange inflows and outflows, miner selling activities, whale movements, network activities, realized losses or gains, and so on and so forth. The bottom line is the CryptoQuant is not a crystal ball, but it is the closest thing that will get you to having one. Because when you can see whales preparing to sell, miners refusing to sell, exchanges quietly filling with coins, you don't need headlines to tell you that something big is about to happen. So if you want me to create a step-by-step guide on how to use CryptoQuant, both for the free version and the paid version, comment with free CryptoQuant and I will do that video for you. So if you enjoyed this video, kindly smash that like button and subscribe to this channel. And also remember the tools we have mentioned so far: the MV RVZ score, the Coindays Destroy, the stablecoin supply ratio, the Nansen, and then the 5th one, the CryptoQuant. So make sure you jot all these things down and start looking into this tool. Even if it's just 2, if you just combine 2 of them, it will put you ahead of 99% of most people in the crypto industry, because most people don't know about this. They are not even talking about it. They are not pulling up all these charts or these tools. They are not using. They're just focused on looking at the charts, green candles, red candles, supply and demand, and all that, or pump.fun and all that. But you are now equipped with informations, with tools that can help you trade like the institutions do. You can also become a whale tomorrow. So if you enjoyed this video, click on the next and learn more from this.